came. When did it come out? Well, it was updated yesterday afternoon. The Federal Reserve signaled Wednesday it would lower interest rates 2 more times this year. Guys, what have I been saying? You know, I don't want to say that I have a crystal ball, but the writing really was on the wall as far as where we were going to take things for interest rates. Historically speaking, our interest rates are not that high. In fact, we are just under the average for the last 40 years. But by all accounts, our inflation's higher, and we are trying to get things down to our target inflation. And numbers are just, rate is one of the mechanisms we use, interest rates, in order to get us within that neutral rate. So here they're saying that the benchmark federal funds rate by 50 basis points to a range of 4.75 to 5%. So they see it coming down to 4.4% in 2024. So that's pretty significant there. So just the Fed will cut rates by an additional 50 basis points later this year. Fed has moved in 25 basis increments over the last year or so. That's pretty much how we've been doing it up here north of the border. FlexM, thanks for joining. Kelly White, appreciate you for coming on this. We're just talking mortgages and financing. Are you buying a home? Are you in the market? Are you renting? Tell me what's going on in your neck of the woods. And where are you guys from? That would be awesome if you let me know. So with all of these signs pointing towards further rate cuts south of the border, we can pretty much guarantee that we're likely going to see that here north of the border. And people say, oh, well, my interest rate's not coming down. There are two different types of mortgage products when we talk about these mortgages that move with the prime, the overnight lending rate. So we've got variable rate mortgages, VERMs, and ARMs. ARM, adjustable rate mortgages. Luca, thanks for joining. So adjustable rate mortgage and variable rate mortgages, one has static payments, the other one has adjustable payments. They go up and down. So depending on what you're in, you may be subject to fluctuations in your monthly payments. But other ones would stay flat. Now, I prefer a fluctuation in the payment simply because it keeps your amortization on track, and you're not screwing around with your amortization, because if your payments stay stationary or static, and we saw this during a raising interest rate market, then all of a sudden your amortization goes out of whack. So the prediction here is, look at this, Western Investor. The Bank of Canada sees growing risk that high rates may push inflation below 2%. Summary suggests. So now there's more talk that we're going to see further. The likelihood of seeing further and deeper rate cuts is on the table. By most accounts, a lot of economists and analysts, people smarter than I am, are indicating and pointing towards a 50 basis point slash in October 23rd, when the Bank of Canada gets back together to talk about interest rates. And we have one more at the end of the year. So I believe it's December 11th. Be a nice little holiday gift to have it drop again. So this will affect your variable rate mortgages. It's also going to affect your secured lines of credit, and it might affect your affordability, right? Because if you're qualifying for a loan and you really want to do a variable rate mortgage, well, as that comes down, it allows you to afford a little bit more from a mortgage qualifying standpoint, because we've got to qualify you on 2% higher than the existing rate. Some members of the Bank of Canada Governing Council are growing concerned that high interest rates may bring down inflation by more than necessary. So let's see. A central bank summary of deliberations released Wednesday offer a glimpse into the council's discussions in the lead up to the September 4th interest rate cut. Some would become more concerned with the downside risks to inflation, particularly if the economy and labor market weaken further. So what do we do to stimulate a weak economy? Well, we drop interest rates, and that should help, at least in theory, stimulate a market. So I don't know if we saw, but EI numbers came out and we're close to 10%. So a 10% increase and year over year. And actually, I'm going to go ahead and flip over to this. EI up 10% year over year. These clouds definitely over tightened. Okay, so in July, the number of Canadians receiving regular employment insurance benefits totaled 489,000 up 2.2%, 11,000 from a month earlier. On a year-over-year basis, the number of regular EI beneficiaries was up by $44,000. I wonder how much of this has to do, though, with our immigration, because we let a lot more people in to the country. And obviously, when you let more people into a country, if they can't find work, they go on EI, and that could be contributing to it too. I'm not sure. That's just my. I have nothing to back that up. It's just my feeling is it could have played into this. So that's what's going on. So what I normally do, guys, is I like to kind of jump on to Reddit. I started doing this a couple weeks ago, and the idea is we jump on Reddit and we kind of look at some of the stuff that's being talked about on that platform, because Reddit, well, at one point in time it was, really the front page of the internet, and now it's just, I don't know, a lot of bots, a lot of shills. People think I'm the one that's being bought and paid for by big banks or Justin Trudeau or Jagmeet Singh. No, I think Reddit is. Okay, but let's see what's going on. My job is on shaky ground, and renewal is coming up soon. Oh, this is an interesting one. Maybe we can answer this question for this lovely person. My 5-year fixed mortgage with Scotia is coming up for renewal. It expires May 1st, 2025. Still about 340 left. As of May, we'll have 20 years on amortization. My job is shaky. I may become unemployed at any point between now and then. Husband self-employed. Is there any chance of our current lender, Scotia, asking for proof of continued employment for me at renewal time? If I get laid off and I'm jobless at renewal time, is there a chance that Scotia would tell us we couldn't renew with them? Likely not. Most of the time you get a renewal, and if you want to shop it around and see if there's something better, and I don't suggest wait until you get the renewal. If you're in an increasing rate market, it's always good to try and lock it out 90, 120 days from your renewal, simply because as you get closer to renewal, guess what? If rates are going up, then you've kind of positioned yourself to kind of hedge against that. In today's market, not so much. Rates are coming down, but there is always a risk that your existing lender, if you're not in good standing, let's say you miss some payments, they don't have an obligation to offer you a renewal, or they'll give you a renewal that is not competitive at all. And I think they know the psychology behind it. If you already have gone through the process and provide all your documentation, do you want to do it all over again? Do you want to requalify? For some people, it's absolutely worth it. For other people, they say no. Mike Versick, thanks for joining me. A bunch of people had joined and jumped off here. I'm streaming on 2 platforms right now, TikTok and YouTube. Check me out on YouTube if you guys haven't yet. It's just Pico Mortgages, and I'm going to start doing a little bit more over there. But I love my TikTok crew. You guys are great too. Share this with anyone that you think might benefit and have questions, obviously, on mortgages, because that's what we're talking about. So in this case, they'll likely get a renewal offer if they're in good standing. I wouldn't worry too much about it, although there are talks, and hopefully they don't do this, to requalify people on renewal down the road, even if you just stay with the existing lender. But for now, you don't have to worry about it. Hope that answers your question and your concerns, Altruistic Unicorn 99. What else we got? Here's a good one. Broker keeping half of earnest money. No, that's I don't know. Okay, here we go. This is Rate Hub, rate comparison website. They got a lot of teaser rates on there, rates that most people are not eligible for. But, it's a good starting point, especially if I'm doing a conversation on affordability. And we want to talk about, well, what's the stress test and why are we not qualifying you on the lowest rate in the market right now? But you can see here they put in some parameters. It's a fixed rate mortgage. It is insured because it's 5% down. It's likely a purchase. This is not going to be a renewal. And obviously a refinance is not 5% down. You have to have equity in it to take out money. So insured 3.99. It's hidden behind Canadian lender. No idea who that is, but again, it could be anyone. But yeah, rates are coming down. 4.39 is standard right now. But my advice is if you are looking to renew, don't renew into a longer term fixed rate mortgage. It's probably best that you just kind of ride it out. You take a short term, 2 or 3 year term, and then you have the opportunity to reassess the market at that time, or go variable. I mean, some lenders are prime minus 120 basis points right now. Now that is going to shrink. Absolutely, that's going to shrink the discount to prime. I had a journalist from the Toronto Sun call me up earlier today, and we were chatting about this and just the affordability issues that are facing the Gen Z crowd, but the opportunities here that might occur if you can get a few people together to purchase, especially if all signs are pointing to lower interest rates and there's going to be more buyers entering the market. 100%. There are more people reaching out right now asking for pre-approvals and to revisit their applications that they put on hold a while ago. So I'm seeing it. And usually, on the mortgage side, we see it first before the realtors see it, simply because they want to get all their ducks in a row. And if that's the thing that pushed them to the sideline was, I don't know if I can afford it, they're going to go back to the mortgage side first to see if they can afford it. And that's what we're seeing. Okay. So yeah, 3.99. What else we got here? Okay, what amount could my wife and I qualify for? Okay, this is a tough one. When you put it out on a forum like this, depending on where it's being qualified, and then there's 3 insurers in Canada, right? So we've got Canada Guarantee, Sagen, and CMHC. So they all have different policies if you're getting an insured mortgage and slightly different ways of looking at your income. Just go get it reviewed by a mortgage broker. Fed lowers rates by 50 basis points. We just chatted about that. Let's see. But here's something interesting. So this guy, his name's Matt Imhoff. He talks in Canadian Mortgage Trends about mortgage prepayment penalties. Does anyone know about mortgage prepayment penalties? Johnson & Johnson, thanks for joining. Priscilla, thanks for joining. The prepayment penalties are calculated on a discharge statement, which is ordered typically when you're paying out a mortgage. Now, if you win the lottery, you're going to pay out a mortgage. If you move lenders, you're going to pay out a mortgage. If you end up selling the matrimonial home, you're going to pay out a mortgage. And you're subject to mortgage penalties. In the case of fixed rate mortgages, it's going to be the greater of a 3-month interest penalty or an IRD penalty, interest rate differential penalty. So Matt talks about this and starts to shed some light on it because, up until now, a lot of people don't consider that. They just kind of think about the interest rate they're getting. And he says here, while the allure of a lower rate is tempting, Matt Imhoff, founder of Vancouver-based Meticulous Mortgages, cautions that the way prepayment penalties are structured could catch borrowers off guard. If you tend to chase the lowest rates, lenders often make it up on the back end. Absolutely, 100%. And you can see this with the difference between the posted rate, that's the rate that they have on their websites, and then the advertised special rate. And we're seeing those rates come down. Sure, there's 3.99 on the market. What's the posted rate, right? Because if they're giving you a higher discount and that discount is used to determine what your penalty or how hard they're going to kick you in the pants when they open the door and send you on your way. And it's the difference between literally thousands of dollars. Once that posted rate drops, if your spread is still, fairly large, posted rates come down, your penalty comes up. Inverse relationship. So it's something to take into consideration. And that's something that they're not going to tell you. If you walk into a bank, I guarantee you probably 9.8 out of 10 folks that are helping you on a mortgage side, they're not going to know what their posted rate is. They're not going to know how to calculate that IRD penalty. And they're not going to tell you. They're not going to be watching it to say, hey, look, you're still in a 3-month interest penalty. If you want to get out of the fixed now and jump to the variable side, now's the time to do it. Because if posted rates come down, another 10 basis points with your lender or 20 basis points is going to tip you over to the IRD penalty, and then it becomes cost prohibitive. And we're seeing a lot of that, actually. I've got clients that we've tracked everything in our system, in our database, and what I've done is I've basically filtered out everyone over the last 12 to 18 months. And what we're looking at is who is in a fixed rate mortgage, who's the lender, what's the interest rate you're paying, and is there an opportunity to move you to a variable rate? Because if you think about it, if you're in a fixed rate, and I've got clients that back then interest rates high 5% was good. That was actually a very competitive rate. But now if we're seeing interest rates getting down to 4% on the fixed side, variable is very close too. And if the discussion is further rate cuts, you want to be in a position where you can take advantage of these. So one of the strategies we're doing is we're looking at it and saying, well, what is your break penalty today? Let's order that discharge, or simply let's reach out to the lender and say, hey, if I was to pay out my penalty today or pay out my mortgage, what's my penalty? Once we determine that, there are some lenders that have cash back. Now, this is different than refinancing. What's up, Patrick? Thanks for joining. If you have questions, just put it in the chat. I'm talking everything mortgage related. So if you've got a mortgage and you're considering going from fixed to variable, you are going to incur a break penalty. You can go variable to fixed. That's no problem. And you can lock it in with many lenders without incurring a penalty, but you can't go the other way around. So once you trigger that penalty, the question is, what's that penalty and is it worth it to move? So some lenders are actually doing cash back, and it's not a refinance. What they're doing is they're basically saying, okay, you know what? With a non-cash back, we'll do prime minus, let's say 1%. Cash back, we'll do prime minus 90%, you get 1% back. Or prime minus 70 basis points, you get 2% back, right? So the idea here is we match you with whatever your penalty is in order to have the new lender pay it out from the cash back. And if you get some extra cash back, I always say, hey, just throw that directly on your principal, because if you had a $500,000 balance and you're getting 2% cash back, that's 10 grand. Your mortgage doesn't move to 510,000. It stays at 500,000. We move it to the new lender. Let's say your break penalty is $5,000. Now you get $5,000 in your account. What do? You can do two things. If you've got credit cards with higher interest, boom, throw it right on there. My beautiful 145, thanks for joining. So you could throw it on your credit cards to pay down your higher interest and daily compounding interest debt. Or you can also, if you don't have a lot of unsecured debt, put it directly on the principal of your property. Exercise your repayment options, take that $5,000, throw it right down, and from day one, it is hitting the principal. So that's going to help you overall with the amount of interest you're paying. So that's one strategy to get out of a fixed rate at a higher interest rate, have the new lender pay it, and then you can ride that wave down. So let's say you get a prime minus 70 or 75 basis points, you get your cash back. Now you're in a situation where you say, okay, you know what? Prime minus 75 right now is 5.7%. Okay, but maybe that's around the interest rate you had when you're on the fixed side. But by all accounts, if we kind of take into consideration what, Bank of Canada is seeing here, what the feds are predicting here south of the border, additional rate cuts are on the way, well, then we get to sort of ride that coaster down. And if we've got 1% coming by the end of the year, which is a very high probability of happening, then you just shave 1% off your 5.7. Now you're at 4.7. All big six banks in Canada. So we've got RBC, we've got Bank of Montreal, we have TD, Scotiabank. Who am I missing? I got 4. We got National Bank, 5. I missed one in there. CIBC, did I say that? Anyway, all of them have their own economists, and they're all predicting anywhere from 2 to 3% of a reduction in that overnight lending rate. So if we see another 1.5% come down by summer of next year, I think you're in a good position. I also do a lot of spreadsheets that kind of run the scenario, the analysis, and I'm happy to share those with you guys if you want to take a look at them. So that's kind of what's going on today in the world of financing. Let's see, is there anything else we should talk about here? 3-year fixed or variable closing this week. Okay, hey, this is a good question. So if someone's closing this week, we're closing at the end of this week. So quite frankly, I'm not even sure if there's still time to change. Okay, yeah, this is a good question. You can't just change it on a dime. Here's the thing. You got a different rate, and actually he lists it right here. CIBC offered us 3-year fixed 4.9 or 3-year variable 5.65. Remember I talked about a stress test or a mortgage qualifying rate? So if you were qualified on a 419, you add 2% to this. Your qualifying rate is 6.19. Maybe you could afford this mortgage at 6.19. But if we move you to a 565, you got to qualify in a 7.65% interest rate. Maybe you don't qualify for that mortgage. So, this should have been done well ahead. Don't wait until the week that you're going to close, simply because this has got to now go from being instructed to the lawyer's office. So your file complete on it. They've committed to it. They've instructed. It's gone through risk. Now it's got to go back to underwriting, and they have to re-adjudicate the entire file. They have to see if, debt ratios are over. They got to send it to the risk department. Changing Lives 888. Thanks for joining. We're just talking right now about fixed or variable, which is the better option. And if you are making the change, maybe it's not a good idea to do it days before closing. You could actually really screw things up. So they opted to go with fixed, even though it's a pain. Even though it did pain me knowing that interest rates will continue to go down, especially so with the recent inflation news. So then why did you go with it? Probably because they couldn't qualify. What do you take as for reference to 3-year uninsured as we were putting 200% down and a mortgage of just under 900,000. Yeah, I mean, you can see right here, everyone's saying variable. That would be my take too, because 3-year fix at 419 isn't, if we have this conversation in 3 months, this person's going to be like, wow, why did I do that? And the question has to be on a 3-year fix, what is CIBC offering at the posted rate? Roberto, thanks for joining. Because that posted rate and that discount to the posted rate is what's going to factor into his or her ability to maybe break this early and move to another lender. So you got to take that into consideration. And you should have done it earlier. Okay, bank won't approve as is. Can a bank decline mortgage approval based on pictures? House needs a lot of cosmetic, but has all the basic needs, resources, power, water, heat, structure. It's being sold as is. Stay away from that. Private or B lenders with 5%. There's so many things wrong with this question here. And obviously this person is not educated enough to really understand. Before they even consider putting in an offer, I would highly recommend you sit down with a mortgage professional. Not necessarily someone from a branch, because that person may not be the mortgage specialist. It may be someone that is just helping out, right? And not to nog it, I worked at one of the big banks for a while. Blazy Susan, I like your name. Thanks for joining. If you have questions, just put it in the chat. Okay, so 5% down, you have to get the blessing of the insurer. And there are 3 insurers in Canada. Not all banks work with all 3 insurers. Some have their preference. They might go with Sagen. Some might go with just CMHC or CMHC and Canada Guarantee or something like that, right? But all of them have requirements. One of them, obviously, is going to be that if they are providing a loan and a high-risk loan at that, they want to make sure that the collateral, that is the house or the property they're putting this charge on the title, is in good shape. So if it needs a lot of cosmetic issues there, you likely won't. Can I dispute or inquire further? Now, one of the things is the lenders are always looking. They have, believe it or not, access to the internet, so they can go in there and Corey, what's going on? Thanks for joining. So if they go on the internet and they just Google a house, they're going to have all the information on it. And in fact, they're going to have a copy of the MLS and the purchase agreement. They're going to take a look at the MLS and they're going to look and see if there's anything on there that is a red flag for that property, because they want to make sure that property is in good condition, right? So it's imperative to make sure that house is structurally sound and in good condition. We do have mortgages called Purchase Plus Improvements. Usually they're capped, and that's is on the insured side, capped at, I believe, around 40,000. But it would not be for large structural stuff, and you can imagine 40,000 doesn't go very far. You might be able to, spruce up your kitchen a little bit, or maybe put a 2-piece washerman in. But this sounds like it's way out of the realm. Banks won't lend if the home isn't considered 95% complete. Not exactly accurate. It's actually depending on the bank, but I've seen 97 or 98% complete. All right. So anyway, let's see. When do monthly mortgage payments go down? Freeland allowing more through higher values for insured mortgages. Did I not just say this? I could have sworn. Okay, so yeah, that's sad. A lot of students overwhelming the food banks. Original owners suing for the house. Okay, that's in Florida. Unpaid principal balance. Okay, that's someone's. I think that's in the U.S. $730,000 condo. Well, it wasn't worth $730. Someone overpaid for it. Let's see. No offers. 250 days on the market. And that's the thing. Like in today's market. Okay, so before these new rules come into effect, we're going to have an opportunity here where the people are still priced out before December 12th or 15th or whatever it is. But I think as soon as that shifts over, we're going to see more demand. Absolutely. So some properties that are sitting on the market for a while, 50, 100 days or whatever, you're going to have a better chance to negotiate and get deeper discounts now than you would. And for some people, they may even just hold off on putting their property on the market until they're the new rules come out on December 12th. So we might actually see a little bit of contraction on the amount of inventory in certain markets. I think that's highly possible too. I think I'm coming down with a cold or something. It's a good thing you can't get it through this microphone. Okay. Mortgage gap due to appraisal. Ooh, this is a good one. Okay. Oh, damn, where'd it go? Well, here's a good question. Hey guys, I've seen multiple different answers on Google regarding this, hoping for a confirmed answer. We bought a rental property back in June for $280,000 in Alberta. The basement was unfinished at the time. We finished it and rented the whole house out month to month starting July 15th. We just got an unconditional offer from a door knocker realtor for clients for $400,000. We're into it for $310,000. I know after commissions, etc., it's not $90,000, but it's a good chunk of change that we would move us. That will, whatever, move them farther ahead. My question is: does the mortgage broker who got us the deal 5-year variable have to pay back their commission, as we've only had the property for 3.5 months and we'll pay out the mortgage? Possibly. I mean, it happens. It happens on the branch too. I mean, that's neither here or there. It's part of doing business. There's, I think it's, if you're concerned about it, that's great. But would I turn up an offer like that? No, absolutely not. If you want to be nice about it, you can call up the broker. I mean, let's just do a little bit of math on this, guys. If it was a 280 property, okay, they bought for 280,000. They're putting 20% down, right? So you're putting 56,000. That's what is it? 224,000 as a mortgage. Depending if it was A or B lender, your commission might be 1,000, maybe 2,000 tops on it. Now, if you pay for an appraisal up front, take $500 off that. There's not a whole bunch there for the broker. As a gesture of kind will, if you wanted to, you could always call out the broker and say, how much are you out of pocket or how much are you going to claw back, and cover it. But I mean, at the end of the day, I wouldn't think twice about selling because you're concerned about the broker losing the commission. It is what it is. It's a cost of doing business. RBC moving from 5-year variable to a fixed. Here's a good question. Do I pay a penalty for this change? And do my payments go down assuming I can get something closer to the low 4s? Why am I getting a server error? Oh boy. Hopefully I'm still streaming. Travis, JMac, thanks for joining. I'm still getting a server error. So if you're going from a 5-year variable to a 3-year fixed, typically you go from same term, like term to like term, right? You wouldn't go 5 to 3. They may do a blend and extend. So if they give you a 3-year fixed, they're going to give you a higher 3-year fixed than they would give someone else to account for the penalty. Why would you move at this point? Oh man, there's so much I can say about this, but why, if your prime minus 65 basis points and this is your payment, why would you move to 3-year fixed? Okay, I have a feeling that they're feeling the cash crunch right now, and it's a cash flow issue. They want lower payments. If you want lower payments, refinance that puppy. I mean, that's the reality of it. From a standpoint of what's a better option right now, we know fixed are coming down. Why would you? why would you do that? Anyway, that's an interesting one. Yeah, I don't see anyone else having questions on it. Blazy Susan, thanks for all you do for this channel. Appreciate it. But I got to get going now. I got a call with a client. We're going to go through a strategy session. We're talking a little bit about investing with them, and they got a few properties they want to take a look at, and we're going to run it through their application to see what the scenario looks like. So I hope you guys are having a great day. I'm going to end the stream now. And again, if you have any questions at any time, you can DM me. I'm happy to answer them. And yeah, if you're not following,